Somewhere in America right now, someone is signing a mortgage. They're excited, nervous. They've read every article on down payments and credit scores. They think they understand what's happening. They don't. Because the number on that page, the interest rate that will shape their life for the next 30 years, wasn't set by their bank. It wasn't set by the Federal Reserve either, even though almost everyone assumes that. It was set by a market they have never seen, never visited, and almost certainly never thought about. A market most people go their entire lives without understanding. That market is bigger than the US stock market, bigger than the housing market, bigger, in some measures, than almost anything else on earth. And it doesn't just set that one mortgage rate, it sets the interest on savings accounts. It quietly decides how much retirement portfolios are worth on any given day. It is, right now, shaping decisions inside companies everywhere. Decisions about hiring, about raises, about whether certain jobs still exist next year. Here's the strange part. Most people who own a piece of this market have no idea they own it. And most people who are affected by it every single day have never once looked at what it's doing. By the end of this video, that changes. You're going to understand exactly what this market is, exactly how it touches your money, and exactly what it costs, or saves, you in real dollars. Not vague theory, numbers you can check against your own life tonight. Hi, viewers. Before we go further, a simple question. Have you checked your savings account's interest rate in the last year? Just curious. Drop it in the comments. Now, here's the question this video is really going to answer. If this market is so powerful, why does almost nobody understand it? Why is it treated like something only Wall Street cares about, when it's already reaching into your mortgage, your savings, and your job? The answer starts with something surprisingly simple. In 2022, this same invisible market did something it had never done before in nearly 50 years. It took the safest part of millions of people's retirement accounts, the part they were told could never really lose money, and made it lose more than it had ever lost in recorded history. Not stocks, the safe part. We're about to find out how that happened, and once you see it, you'll never look at the word safe the same way again. A bond, at its core, is nothing more than a loan. Someone needs money, a government, a company, a city, and instead of walking into a bank, they walk into this market and borrow it from investors directly. You hand over an amount of money, called the principal. In return, you're promised two things: a fixed payment every year, called the coupon, and your principal, back on a specific date, called the maturity. That's the whole idea. A piece of paper that says, lend me money now, I'll pay you a little every year, and I'll give it all back on this date. Picture lending a friend $100. They agree to pay you $5 a year until they pay you back the full 100 on a set date. No mystery, no complexity. Governments and corporations do the exact same thing, just at a scale most of us were never taught to imagine. And one borrower does this more than anyone else on the planet. The United States government currently owes more than $39 trillion. Say that number slowly, and it still doesn't mean anything. It's too large for a human brain to hold, so forget the debt itself for a moment. Just look at the interest, roughly $1 trillion a year, paid only in interest, not even touching the debt itself. That's close to $3 billion a day, disappearing before the government spends a single cent on anything else. It's now bigger than what the country spends on national defense. Every one of those dollars comes from taxes, and the rate the government pays is decided by the same invisible market that decides your mortgage. Which brings us to the one rule that makes everything else in this video make sense. When interest rates rise, the price of existing bonds falls. When rates fall, bond prices rise. Every time, no exceptions. Here's why. Imagine you're holding a concert ticket you paid full price for. Then the venue suddenly announces a better show, at the same price, right next door. Nobody wants your ticket anymore, not unless you drop the price. Bonds work the same way. If you're holding a bond paying 3% and the market starts offering brand new bonds paying 5%, your old bond is now the less attractive ticket. To sell it, its price has to fall until it's competitive again. The payments haven't changed. The bond itself hasn't changed. Only what someone is willing to pay for it has. Hold that idea. It's about to explain something that will directly affect how much you pay for a house. Of everything in this market, one single bond matters more than all the others combined. The 10-year U.S. Treasury, currently yielding around 4.5%. When a bank decides what to charge you for a 30-year mortgage, it isn't guessing. It's looking at that 10-year Treasury and asking a simple question: why would I lend money to a regular household for 30 years when I could lend it to the U.S. government, risk-free, for 10? The answer is, it wouldn't. Not without being paid more for the extra risk. So the bank takes that Treasury yield and adds roughly 2 points on top. Right now, that math lands the average 30-year mortgage rate somewhere around 6.5%, which means the rate on your mortgage isn't really coming from your bank at all. It's an echo of a number set in a market you've never seen. Now imagine that 10-year yield moves just 0.5 percentage point, something that can happen in a single ordinary week. On a typical home loan, that small shift adds tens of thousands of dollars over the life of the mortgage. A full point move, and the number climbs into 6 figures. Nobody sends you a letter explaining this. The bill just quietly arrives, spread out over 360 monthly payments, disguised as the current rate. Here's a question worth sitting with. If a market you've never visited can cost you that much money without ever notifying you, how many other parts of your financial life is it touching right now? For decades, financial advisors gave the same advice to anyone nearing retirement: move out of stocks into bonds. Stocks were for growth. Bonds were the seatbelt, the safe half of your money. Then came 2022. The Federal Reserve raised interest rates faster than at almost any point in the last 40 years. And remember the one rule: when rates rise, bond prices fall. So they did. The broad U.S. bond market had its worst year on record, in an index stretching back to 1976. A typical 60-40 portfolio, 60% stocks, 40% safe bonds, lost around 16% that year. The seatbelt didn't just fail to catch anyone. It was buckled to the exact same seat as the crash. Some retirement funds, holding longer-dated bonds, lost close to 40% in a single year. The worst performance for that type of asset in over 2 centuries of recorded data. Not stocks. The part they were told could never really lose money. There's a single number that explains why some retirees got hit so much harder than others, and almost nobody ever checks it. It's called duration, and it's sitting quietly on every bond fund's fact sheet. Think of duration like a rubber band. A short rubber band barely moves when you stretch it. A long one snaps back hard. A bond fund with a short duration barely reacts when rates move. A fund with a long duration reacts violently. The same rate change can cost 5 times as much, sometimes more, depending entirely on that one number nobody reads. If part of your money sits in a bond fund right now, that number is sitting on your statement too. Right now, unread. The same rule that shakes retirement accounts also explains why the bond market seems to whisper warnings before bad news arrives anywhere else. When a company looks shakier, investors demand a higher return to lend it money than they'd demand from the government. That gap is called the spread, and when it widens, the bond market is quietly saying, "I smell trouble." When real fear hits, a war, a banking shock, money floods out of risk and into government bonds almost instantly. A move traders call a flight to quality. It's the closest thing the financial world has to a fire alarm. Hi viewers, quick question, no expertise required. Have you ever felt confused watching the news say yields are rising, with zero idea what that actually meant for you? Let me know in the comments. There's one more chart in this market that has one of the most talked about reputations in all of finance. And the true story behind it is more surprising than almost anyone realizes. It's called the yield curve, and normally it slopes upward. Longer loans pay more than shorter ones because more can go wrong over 30 years than over 3 months. Simple enough, but sometimes it flips. Short-term rates rise above long-term rates. Economists call this an inversion, and for almost 70 years, nearly every time it happened, a recession followed within about a year. Nearly every time. Not every time, because in 2022, the curve inverted again, for longer than it ever had before. And this time, the recession never came. For the first time in the modern record, one of the most trusted warning signals in economics sounded the alarm, and nothing happened. Not because the signal is broken, but because the economy underneath it had quietly changed in ways almost nobody had priced in. Which raises an uncomfortable question. If a nearly perfect indicator can miss once, how do you know when to trust it again? Let's end where this started to feel personal. Your own cash. Right now, the average savings account in the country pays around 0.38%. Meanwhile, a 3-month U.S. Treasury bill, arguably just as safe, pays somewhere around 3.5% to 4%. A government-issued inflation bond currently pays over 4%, tax-advantaged, with no market risk at all. Picture $50,000 sitting in an average savings account. At today's average rate, it earns less in a year than a nice dinner out. The same $50,000 moved into a T-bill paying 10 times more earns enough to matter without taking on any additional risk at all. Same safety, wildly different reward. The only difference is which door your money walked through. Here is the realization this entire video has been building toward. The bond market was never some distant, Wall Street-only machine. It's the invisible operating system running underneath your mortgage, your savings, your retirement, and the job market you work inside of. It has been pricing your life the entire time, quietly, without asking permission, and without sending a single notification. The people who understand this aren't smarter than you. They just stopped assuming it was boring. And once you know the rule, when rates move, prices move opposite. Every time, you start noticing this market everywhere. In headlines that used to mean nothing. In a mortgage quote that suddenly makes sense. In a retirement statement you can finally read without dread. There's one more hidden rule sitting just beneath this one. The reason some people's money grows faster than everyone else's, even when they're earning the exact same interest rate. That's a different piece of this puzzle entirely. And once you see it, you won't calculate savings the same way again. Please like, share, and subscribe.